Welcome to the Deep Dive. Today we're looking at something pretty powerful for understanding the market's intermarket trading strategies. How movements in stocks might connect to bonds, or maybe how oil prices could impact currencies.
Exactly. It's all about those connections.
We're diving into how these seemingly separate markets actually influence each other.
Yeah.
It's almost like finding hidden clues, right? Clues you wouldn't get just by looking at one market chart.
Absolutely. People tend to focus, very narrowly. But the financial world, it's this huge interconnected system
Right.
analyzing just one piece. It's like watching a football game, but only seeing the quarterback. You miss the bigger strategy, the interactions.
You miss the whole field.
Yeah, the whole field. Intermarket analysis helps you see that, see the relationships, maybe anticipate the next play a bit better.
And for our listeners, who want to get up to speed quickly, thoroughly, without getting totally bogged down in jargon, this is kind of an express route. We're pulling key ideas from Intermarket Trading Strategies by Markos Katsanos. His whole philosophy is that understanding this interplay gives you a stronger footing.
Definitely. It's more than just patterns on a chart.
And what's great about this book, it isn't just theory, is it?
No, not at all. Katsanos actually shows how to build custom indicators, even trading systems based on these connections. It gets really practical.
Yeah, you can tell it's grounded in serious work. He talks about digging through tons of historical data.
Right.
And he thanks people for helping with coding in VBA, getting specific data for correlation studies. The editor of Technical Analysis of Stocks and Commodities Mag, his editors at Wiley.
It feels researched.
It really does.
Yeah.
Which brings us to the core question, I guess. What is intermarket analysis, practically speaking?
Good question.
It's more than just clicking between charts. It's seeing the global financial system as like one big thing, one organism almost.
An organism, I like that.
Yeah, and what happens in one part can send ripples, maybe even big waves across the rest. Okay, let's make that concrete. The book has this great example, right? With the Bank of Japan.
The yen intervention.
Yeah, so they step in, buy dollars, deliberately weaken the yen. What happens next?
Well, straight away, Japanese exporters find their stuff is cheaper for everyone else to buy.
Which could boost their profits.
And often leads to Japanese stock prices going up. But it doesn't stop in Japan.
Right, that's the key.
That good feeling, that positive sentiment, it can spread to other Asian markets first.
Like a rising tide.
Sort of. Then Europe opens, maybe gets a lift. And by the time the U.S. markets open, they can feel that momentum too.
And this connects to that yen carry trade thing you mentioned.
Exactly. It's a fascinating side effect. Basically, interest rates in Japan have often been super low.
Okay.
So traders could borrow yen really cheaply and then invest that money somewhere else with higher returns. U.S. bonds, maybe emerging market stocks, that kind of thing.
Okay. So they profit from the difference in rates.
Right. And as long as the yen stays weak, it works great. Even better when they convert profits back. But the danger
is if the yen suddenly gets stronger.
Precisely. Then hang back that cheap yen gets expensive, fast. It can force them to sell off those other assets quickly.
Triggering sell-offs across markets, like dominoes.
That's the perfect analogy. It's this intricate web of cause and effect, and intermarket analysis tries to map that web.
And it's not just about eyeballing charts side by side. The book really emphasizes digging into the stats, the correlations.
Yeah, quantifying those relationships. And, for shorter-term traders, there's another angle.
What's that?
The time zones. Asia opens first, then Europe, then the U.S.
Right.
So what happens in Asia and Europe can give you clues, maybe a bit of a preview, for the U.S. session, like an early forecast.
Okay, so we get the concept. But what do these relationships actually look like over time? The book uses historical examples.
Yeah, some classic ones, like how bonds, stocks, and commodities tend to peak and bottom at different stages of the economic cycle.
There's that figure 1.3 in the book. S&P 500, the CRB Commodity Index, and U.S. Treasury bonds.
Right, and what you typically see historically is bonds peaking first.
Before stocks and before a recession hits.
Often, yeah. It makes sense. Investors get nervous, they move to safety bonds, bond prices go up, yields go down.
Okay.
And then, crucially, bonds often bottom out first, too. They start sniffing out the recovery before other markets do.
And commodities and stocks follow later.
Usually. Commodities, then stocks. That's the typical sequence.
The book showed this playing out, like late 90s, early 2000.
Bonds peaked 98, stocks in 2000, recession hit 2001. CRB index peaked around then, too.
But there was that exception in the 2003 recovery.
Good point. Yeah, that time, commodities actually bottomed before stocks.
Why was that?
A big factor was the weak U.S. dollar back then.
So currency moves can throw a wrench in the typical pattern.
Absolutely. It shows these relationships aren't perfectly fixed. The dollar, for instance, peaked in early '02, then fell quite a bit against the euro.
And that influenced commodities.
Yeah, it helped fuel the bull run in gold and then broader commodities even after the stock market peak in 2007. It's all connected.
So besides these big cycles, the book mentions simpler things too, like just visually comparing charts.
Or looking at price ratios between two assets. Simple visual checks.
But for really systematic analysis.
You need the correlation coefficient. It's the tool for putting a number on how closely things move together. Is the relationship strong enough to be useful, maybe for prediction?
And this ties into diversification too, right? Table 1.3?
Yes, exactly. It shows how adding assets that don't move perfectly with stocks like bonds or even just cash can lower your overall portfolio risk.
Without necessarily killing your returns.
Right. And interestingly, in the book's examples, commodities actually helped both reduce risk and boost returns in those hypothetical portfolios.
That's a key point about diversification. It's not just about owning different stocks. It's about assets with low correlation.
And the book contrasts that static set-it-and-forget-it asset allocation with a more dynamic approach.
Where you adjust based on these changing intermarket signals.
Exactly. Using these relationships to actively manage the mix.
Okay, let's really zoom in on correlation now. The coefficient.
Right. So fundamentally, it's a stat, a measure. Tells you how strongly two things, like price movements, move together, and in which direction positive or negative correlation.
And the common one is Pearson's.
Yeah, Pearson's are, but it works best with certain assumptions, like the data being kind of normally distributed, bell curve shaped.
And the relationship being fairly straight line, linear.
Exactly. Which, financial markets often aren't that neat.
No kidding. So that's where Spearman's rank correlation comes in. Rho.
Precisely. Spearman's rho is non-parametric. Doesn't need that perfect bell curve assumption.
Okay.
It still looks for a generally linear trend, but it's less thrown off by wild swings, those outliers.
How does it do that?
It uses the ranks of the data points, not the actual values. Think of ranking runners. A couple of superstars don't totally warp the overall rankings.
That makes a lot of sense. Those crazy market days can really skew a Pearson's correlation.
They can, but even Spearman has limits. Both are really measuring linear relationships.
And market interactions can be way more complex.
Yeah.
Nonlinear.
Totally. And the book acknowledges that. It even mentions more advanced tools for tackling nonlinearity, like neural networks or kernel regression.
Sophisticated stuff.
Yeah, but important to know, they exist for those trickier relationships.
Speaking of data not behaving, figure 2.6 in the book shows S&P daily changes.
Oh yeah, the histogram.
Compared to a perfect bell curve, it's different. Fatter tails, longer tails.
Which just means big moves up or down happen more often than a perfect normal distribution would predict.
Reality is lumpier.
You could say that. The book even floats the idea that getting rid of the uptick rule in 2007 might have added to volatility.
Right, the rule restricting short sales on downticks.
Yeah, though it's hard to isolate that effect given everything else going on back then, like the housing crisis.
Fair point.
Oh.
The book also mentions homoscedasticity.
Yeah, great word. It basically means the spread, the variability of the data, should be consistent along the relationship line.
So the volatility shouldn't be wildly changing.
Right. If it is, the correlation number might not be giving you the full picture. It's like comparing things when their fundamental size keeps changing.
Okay, so correlation measures the link.
Right.
What about trying to predict? That's regression, right?
Yeah, regression analysis tries to model that relationship to make predictions. The basic equation is y equals bx plus a.
Y is what you want to predict.
The dependent variable, yeah. X is what you're using to predict it. The independent variable, b, is the slope, a is the intercept.
And you find the best fit line using ordinary least squares.
That's a common method, yeah. Finding the line that minimizes the errors based on historical data.
And you can use more than one predictor.
Absolutely. Multiple regression. Table 3.2 in the book shows correlations for the S&P 500 against lots of things, international indexes, VIX, bond yields.
And they often convert prices to weekly percentage changes first to handle some of those data issues.
Exactly. Tries to normalize the data a bit, make relationships more linear before calculating correlations or building the regression model.
Then you add predictors one by one, see how much they improve the model using R-squared.
Right. But Table 3.3 shows you hit diminishing returns. Adding more and more variables doesn't always help much.
And you have to watch out for multicollinearity.
Yeah, making sure your predictors aren't just telling you the same thing because they're too highly correlated with each other. Need that tolerance metric.
So the book keeps coming back to handling nonlinearity and non-normal data. Scatter plots are a visual check.
Yep. See if it looks like a line or a curve.
Hmm.
And transformations like logs or percentage changes can sometimes help straighten things out.
And if it's really nonlinear,
Then you might need those advanced methods, again, kernel regression, splines, maybe even SVMs or neural networks, as the book hints.
okay, to use all this, you need to know the main markets. The book gives a rundown. Euro stocks 50.
Right, the big 50 Eurozone companies. Market cap weighted, adjusted for free float, started back in 91.
Nikkei 225 in Japan.
The most watched Japanese index. Price weighted, which is a bit different. High-priced stocks move it more. Reviewed annually.
The book makes a good practical point about ticker symbols varying.
Oh yeah, can be confusing. And it sort of ribs U.S. brokers for sometimes ignoring international markets.
But if you're trading international ETFs or ADRs,
You absolutely need that international data. It's crucial.
the book also has that reality check, Table 4.4, comparing actual market moves to what a normal distribution predicts.
Yeah, it shows how unreliable predictions based purely on normal stats can be, especially for those big outlier moves. The tails are fatter than theory suggests.
And it revisits the uptick rule removal in '07 again.
Put in after the 29 crash to slow down short-selling cascades.
But hard to pin recent volatility just on that rule change.
Very hard, yeah. With the financial crisis happening at the same time. Too many moving parts.
Okay, a huge player. The US dollar index, DXY.
Central to everything, really. The book breaks down its basket. Euro is the biggest chunk, then yen, pound, Canadian dollar, krona, Swiss franc.
Figure 4.1 and table 4.7 show the weights.
Right. Getting real-time intraday values for the index itself can be tricky sometimes.
But the Euro USD rate is often a decent proxy because the euro has such a big weighting.
Yeah, table 4.8 shows a high correlation, so Euro USD gives you a pretty good sense of the dollar's general move.
And the dollar's role.
Yeah.
It's massive. Affects everything. Since Bretton Woods ended and it started floating freely, big swings.
Huge swings. Then commodities. The book outlines the main indexes, CRB, old and new versions, and the GSCI.
Table 4.1. And the GSCI is really heavy on crude oil, right? Figure 4.3.
Very heavy. So its movements are super tied to oil prices. You got to know that composition.
And finally, the XAU index.
Represents gold and silver mining stocks. Table 4.13 lists the components as of early 2008. Gives you a way to track that sector.
So a really crucial point the book makes is that these correlations aren't fixed. They change.
Oh, absolutely. They're dynamic. Table 5.1 is fascinating. It shows yearly correlations, S&P versus world indexes 92 to 07.
And the connections seem to get stronger, more consistent in the later part of that period.
Generally, yeah. Suggesting maybe increased globalization, markets moving more in sync, at least during that decade from 98 to 07.
Figure 5.1 shows the S&P versus the Dow. Visually very correlated, as you'd expect.
Right, super high correlation there. But the warning is, don't just assume past correlations will hold. You need to adapt.
Table 5.4 uses that Spearman method for weekly returns S&P versus world indexes, long and short term.
And table 5.5 is a big matrix. Futures contracts, DAX, S&P, E-mini, Dow, NASDAQ, Nikkei, Euro stocks, currencies, gold, treasuries.
Wow, it really shows the web.
It really does. Everything is potentially linked to everything else.
Okay, let's talk about gold. The book uses it as a detailed case study.
Yeah, gold is complex. Had that huge peak in 1980, then a long slump, then the rally starting around 2002.
But long term, compared to stocks like the S&P 500.
Historically, stocks have generally done better, especially after inflation over the really long haul. Gold has its moments, but stocks tend to grow more consistently against inflation.
And the currency effect is huge for commodities like gold. Figure 7.2. Gold in dollars versus gold in euros.
That's a brilliant illustration. From 2002 to 2005, gold in dollars was trending up nicely.
In euros.
It was pretty much flat, sideways, because the dollar itself was weakening against the euro then.
So the dollar uptrend wasn't really a gold bull market for a European investor.
Not in the same way, no. Shows you have to consider the currency you're measuring in.
The book also mentions seasonal gold demand, jewelry buying in the fall.
Yeah, September to December often sees higher demand, but
big macro stuff, like a plummeting dollar, can overwhelm that seasonality. Figure 7.4.
exactly, the big trends often trump the seasonal patterns.
And correlation-wise, Table 7.4 suggests gold often lags or moves with related stuff.
Yeah, related commodities, mining stocks. It implies that for short-term forecasting of gold, Maybe looking at those related markets gives you a better clue. The lag wasn't huge, though, like within 10 days in the study.
Okay, this is great background. Now, the really practical bit. How do you use this stuff for trading? Custom indicators.
Right. The book gets into designing your own indicators based on these intermarket links, specifically to forecast stocks or indexes.
Like the intermarket disparity indicator.
There's a formula. Basically, it compares how far a security is from its moving average versus how far a related intermarket security is from its moving average.
And adjusts for their correlation.
Yeah. The idea is to spot when that difference, that disparity, gets unusually wide. That might signal a reversion trade or a breakout.
Then there's the intermarket momentum oscillator.
That one builds on the disparity indicator. It tries to identify when the disparity readings hit extreme highs or lows.
Interpreted kind of like a stochastic oscillator, looking for overbought, oversold signals between markets.
Sort of, yeah. That's the basic idea.
And the z-score divergence method.
That's about normalizing prices. You convert the prices of two securities into z-scores, how many standard deviations from their average they are.
So you can compare them on an apples-to-apples basis.
Exactly. Then you look for divergences. Is one making new highs in z-score terms while the other isn't? Figure 9.6 uses gold and the euro as an example, showing leads and lags.
But the catch is, it assumes prices are normally distributed.
That's the main caution, yeah. Which we know isn't always true, so use it carefully.
What about using multiple predictors? Multiple regression?
The book touches on it. The math gets complex, but software can do it. The trick, as mentioned in Table 9.3 with gold, silver, dollar, CRB,
is finding predictors that correlate well with what you're forecasting.
But don't correlate too highly with each other. Avoid that multicollinearity problem again.
Got it. And the congestion index, CI, not strictly intermarket.
Right, but it's used in some of the intermarket systems later. It measures whether a market is trending strongly or just chopping sideways.
Between plus 100 and 100. With the middle range, like plus 20 to net over 20, being congestion.
Yeah. The idea is that breaks out of that congestion zone can signal the start of a new trend. Appendix A has metastock code. Table 9.8 shows an Excel calculation.
Okay, so we have potential tools. Now, building a trading system. The book talks about removing emotion, saving time.
Definitely key benefits. But it also wades into that efficient market hypothesis debate. Can you actually beat the market consistently?
The EMH says basically no, it's all random.
But the book points out anomalies, things that don't quite fit the theory. And real traders worry about risk tolerance, liquidity needs, stuff the pure EMH doesn't fully capture.
And those factors might create openings.
Possibly. Opportunities that a purely price-focused model might miss.
Then there's system optimization, testing parameters on past data.
Crucial step, but then the big warning, curve fitting.
Fitting the system too perfectly to the past so it fails on new data.
Exactly. It looks great in backtest, but falls apart live. A major pitfall.
So how do you evaluate a system properly? The book lists metrics.
Yeah, lots of stats. Percentage profitable trades, obviously. Buy and hold index for comparison.
The luck coefficient.
Yeah.
Pessimistic rate of return.
Right. Luck coefficient tries to gauge how much might just be chance. PRR looks at a worst-case sequence of trades for a more conservative outlook.
Exit efficiency. Total efficiency.
Exit efficiency.
Yep.
How well did you get out of winners near the best possible price? Total efficiency. How much profit did you capture versus the total potential profit available? Useful metrics.
And using a t-test to see if the system's profitability is statistically significant.
Yeah, comparing its average trade profit against a benchmark like zero or buy and hold returns adds some statistical rigor.
And risk management. Drawdown is key.
Absolutely critical. Maximum drawdown, the biggest hit your equity takes. Also looking at open versus closed trade drawdown. And MAE.
Maximum adverse excursion, the worst paper loss on any single trade.
Yeah, helps understand the potential pain per trade.
Then comparing risk and reward. Risk-reward index, risk-adjusted return.
Standard ways to see if the potential reward justifies the risk you're taking.
Stop losses are covered too, different types.
Fixed percentage, trailing stops, price levels, volatility stops, indicator-based stops, lots of options.
But the author found sometimes stops actually hurt profitability if the system already has good exit rules.
That was his observation from testing, yeah. Sometimes good exit logic for winners is better than a crude stop loss that might cut winners short or get hit by noise. It depends on the system.
In money management, how much to risk per trade, Kelly's system, optimal F.
Briefly mentioned, yeah. Methods to determine position sizing, crucial but complex topic in itself. Fuzzy logic gets a nod too.
For handling vague rules like human judgment.
Sort of, yeah. And AI software exists for system development, but it's costly and has a learning curve.
The final takeaway on systems seems to be study the past, backtest rigorously.
But never forget, past performance doesn't guarantee future results. All results shown are simulated. For experienced traders, manage your risk. That's the mantra.
Okay, let's touch on some specific system examples from the book, just to give a flavor. Trading gold.
Yeah, single intermarket systems using regression and disparity with the dollar index DXY and the XAU mining index. The book notes they outperformed buy and hold gold in the tests.
A relative strength system for longer-term investors.
Using moving averages of relative strength. And a regression divergence system for the S&P 500 tested out of sample.
Trading DAX futures using divergence with French or Eurozone indexes.
Yep, looking for when the DAX moves out of sync with the CAC 40 or Eurostoxx 50.
Using multiple regression for FTSE futures, combining international indexes, currency, interest rates.
Right, comparing that approach to a neural network system, highlighting the potential power but also the black box issue with neural nets, hard to know why they make a decision.
Applying this to individual stocks too, comparing a stock to its commodity or sector index.
Yeah, using relative strength and correlation as filters. The idea is to potentially improve stock picking performance and cut down risk.
And broader asset allocation systems, using relative strength across different asset classes or ETFs.
Yes, systems designed to shift capital towards the stronger performing asset classes based on intermarket signals.
Finally, Forex trading, using intermarket analysis.
Right. The book notes the unique aspects: liquidity, leverage, spreads, not commissions, data issues sometimes. Economic reports are huge drivers.
And examples for trading yen and euro improved with intermarket filters.
Exactly. Like a yen system looking at its disparity with treasury yields, TNX, the dollar index volatility, or a euro system filtering trades based on how the euro moves against TNX and commodities, CRB.
And the yen carry trades impact on pairs like Aussie yen, AUDJPY.
Touches on that too, yeah. Shows how these bigger intermarket themes play out in specific currency pairs.
So wrapping this all up, the big takeaway seems to be intermarket analysis gives you a valuable lens, right?
Right, really valuable framework, yeah, for understanding and maybe even anticipating market moves by seeing that interconnectedness.
But crucially, correlations change. Nothing's guaranteed.
Absolutely. Correlations shift. No system is foolproof. But blending these insights with traditional analysis, it can potentially give you an edge.
An edge based on a broader perspective.
And rigorous testing, probabilistic thinking, the book hammers those points home. They're essential.
So maybe a final thought for listeners. Look at the markets you follow, even ones that seem disconnected. Could there be hidden links? Could an intermarket view reveal influences or opportunities you've missed?
It's worth asking that question. Explore those relationships in your own areas of interest.
We've really just skimmed the surface here today.
Definitely. There's a lot more depth in Katsanos' intermarket trading strategies.
So if this sparked your interest, digging into the book or finding other resources on this topic would be the next step.
Highly recommended if you want to go deeper into these fascinating market dynamics.